We've had economic data filter through in South Africa, where we've had the country's September vehicle sales numbers released. New vehicle sales up 1.4% year on year. The surprise slowdown being attributed to the impact of the mining sector's labour unrest in business confidence. And joining us for more on this now is Chris de Kock from WesBank. Chris, thanks so much for joining us this afternoon. So those are the headline numbers that we're looking at right now. How are we interpreting the numbers that have come through today? What does it tell you about the state of the South African vehicle industry and then, by extension, the South African consumer?
Well, I think, first of all, I think the numbers are less dramatic than perhaps what has been suggested. We must not forget that September was a very short month, 19 trading days, compared to 21 trading days last month and 23 trading days last year. So one has to take that into context. 3 or 4 trading days out of 19 is a big percentage, so it does have an effect. If one has a look at the number of vehicles that were sold per day, and indeed, from our perspective, from the number of applications we received per day, the numbers were as strong as they were in August and as strong as they've been for the rest of the year. Having said that, we have always said that the growth, when compared to 2011, is going to be very difficult to continue that huge growth we've seen, particularly in the middle part of this year. The last 4 months of last year were very strong for the motor industry, and the base effect now has kicked in, and I think it's unlikely that we're going to see high growth rates for the remainder of this year. But on the whole, the numbers are still very, very strong. We're still selling a substantial number of cars, and that has been driven off the back of the fact that it's still a buyer's market. Vehicle CPI is low, interest rates are low. It's a very competitive market out there. Consumers are seeing some certainty in terms of the macroeconomic situation, and therefore they are rushing to dealers and buying cars.
I mean, just
Chris, you've answered a couple of the questions actually already, but what is really driving it? Is it the competitive nature of the market? Is it the fact that there is a sort of a raft of affordable vehicles coming into South Africa and they're being promoted quite heavily? Is it innovative financing? Is it the consumer confidence? Is it the wealth of the South African consumer, or a combination of all the aforementioned?
No, I don't think so. I think there is a bit of logic behind us as far as I can tell. First of all, there's 2 factors that we know traditionally impact on the buying public. The first one is the cost of cars, and I think, as we mentioned, the cost of vehicles has actually over the last 2 or 3 years gone down. Whilst the actual cost might have gone up a few percent, the value that manufacturers have given to consumers has in fact increased. So the actual cost of a car has gone down. And combine that with 40-year low interest rates, you've got almost a perfect storm. So you have a situation where consumers are faced with the fact that you can replace your car today, which is now 3 or 4 years old, with a same or similar vehicle for a cheaper price. I mean, that is a perfect scenario. How often in an economy do you get a scenario like that? Hardly ever. So it's no surprise then that the demand from consumers is continuing to be strong off the back of that. It's not off the back of credit. I think that banks have been quite tight in terms of credit. And remember that when the National Credit Act came in 2007, it provided a completely different mechanism for banks to assess credits. All of a sudden, banks had complete transparency of the customer's income and expenditure, and indeed their whole debt portfolio. So making conscientious credit decisions was a lot easier for the banks. So as a result of that, the approval rates were subdued. So it's definitely not off the back of credit. From a sustainability perspective, as long as those 2 factors remain in place, and there's no real evidence to suggest that they're going to change, in my view, there's no reason to suspect that the demand is going to slacken off to any great degree.
I think a question I'd like to ask you, I mean, if you look at the new passenger vehicles, those on a year-on-year basis certainly up. But if you look at the underlying sector, so you look at light commercial, medium commercial, heavy commercial as well, which certainly doesn't make up the bulk of the number, but those have all deteriorated on a year-on-year basis. So looking through the cycle, if businesses are not investing, what kind of picture in your view does that paint for economic growth? And then obviously by implication, I mean, yes, the consumers benefited from these historically low interest rates, but as that works through the cycle, how long do you see that before it impacts the passenger vehicle market?
Very complicated question you asked there, but I think first of all, you're quite right. The corporate side of the market has completely different buying go through a very different conscious buying signal than the consumer. The consumer is much more orientated towards short-term and towards value that they can get today, whereas the corporate market looks a lot more long-term and they look at capacity. So clearly what we're seeing in those numbers is that there is sufficient capacity in the corporate sector, and there's really a lack of capacity building. All we're seeing there is a replacement cycle. So the second part of your question says, well, how long is that going to start to impact consumers? And I think that is inevitably one must assume that if South Africa continues with its low growth rate, that ultimately that's going to result in lower growth of earnings in consumers, and that ultimately is going to impact on it. So how long that's going to take, I really don't know. But I think that to a degree, if vehicle CPI was traditional, in other words, it was growing 5 or 6% a year, if interest rates were sitting at a more moderate level, then those factors would be having a much greater influence on vehicle sales. I think vehicle sales are being masked to a degree by the fact that it's such a buying market. And I think one other point which I think is very important is that when we look at these growth numbers, and you asked the question around, is this an indicator of the economy? And I think vehicle sales has always been a good indicator of the economy. But there's one part of the vehicle sales market that we don't talk about, and that is used cars. And bearing in mind that for every one new car that is sold, 2 or 3 or 4 or 5 used cars, depending on the age category, is sold. So you really are only looking at half the picture. And what is definitely happening, and we can see that in our numbers substantially, is that there's been a growth in the new car market as a result of a migration of customers who used to seek value in the used car market, who are being dragged into the new car market.
We had this conversation earlier this week where there's a change in the way car manufacturers, dealers, financiers all approach the market. There's an evolution, so to speak, of how they're looking to net in the average consumer.
No, definitely. So you're seeing this migration of consumers from the used market, who traditionally would be there, into the new car market, which is inflating to a degree the new car sales. So again, when we look at the growth in new car sales, we should consider A, the perfect storm that I spoke about around replacement cycles, and B, that those numbers are slightly inflated due to this migration, which will over time migrate back to used. The used market will find its equilibrium once more. The gap between used cars and new cars will be restored once more, and those customers will migrate backwards, and that certainly will have a negative effect.
Yeah.
Chris, I'm sort of replicating what Mohammed was intimating earlier on about the light commercial vehicles, medium and heavy commercial vehicles or heavy goods vehicles side of the figures that have just been released. And I'm a simple sort of person. I go out from CNBC Africa's studios here in Cape Town and I look across the horizon and I see a few cranes here and there and I think, okay, people are building, therefore there must be some economic activity, confidence that justifies that building. And if I see lots of buckies around and lots of lorries and trucks and things driving around transporting goods, I think that means that the economy is going as well. But noting your figures, 8.6% down for the heavy truck segment, etc., 7-8% down across the board for the commercial segment, tells me that perhaps in the future it says something about the South African economy. Would you say these numbers are a leading indicator?
Well, I think one also has to understand the different sectors in that heavy market. You've got mining, you've got construction, you've got transport, you've got manufacturing. And what tends to happen in the corporate market, unlike the consumer market, which is really just driven off one set of demand criteria, the corporate market is driven off completely different. So right now you're seeing quite a bit of pressure in the transport sector and in the construction sector, and indeed in the mining sector, which has been fueling the growth of those sales over the last certainly year. Even that sector is now starting to falter, whereas sectors like the agricultural sector are in fact doing incredibly well. So I think what we're seeing in the numbers is really just a shift from one segment into the other segment, as opposed to anything more determined. So again, I think that it would be dangerous to read anything particular into those numbers, other than to say that generally speaking, I think there is sufficient capacity in the industry, and there's not too many companies who right now are putting their hands in their pockets and building capacity with their view of what's happening long term.